You're now listening to the Tax Smart REI podcast, the number one tax podcast for real estate investors. Thanks for tuning into this week's episode of the Tax Smart REI podcast. Today we're joined with Nathan Sosa, and we're going to be talking about something that we've not really discussed too much here on the show, and that is the Section 179 deduction, which is a deduction for small business owners and commercial real estate investors that helps them expense certain capital expenses immediately rather than depreciating them. And it's not really been that popular, at least in our realm of the world, over the last few years because bonus depreciation has often overshadowed it. And there's some other reasons that we'll explore today and why that is. But we have been getting a handful of questions on this, so we figured now is a good time to address this. So we'll be diving into all of that in just 1 minute. Most landlords are closer to achieving their financial goals than they realize. They are just a few moves away from meeting their cash flow goals and finally achieving financial freedom. Introducing Property Llama, the game-changing tool designed to help you unlock hidden opportunities in your real estate investments using the equity you've already built up in your portfolio. Property Llama is an online investment platform built by real estate investors for real estate investors, and their user-friendly dashboard gives you a crystal clear picture of your entire portfolio, and their team of real estate experts is there to help you plan the moves you need to make to hit your goals faster. With Property Llama, you can track and benchmark your investment's performance, model what-if scenarios to make smarter decisions, and work with their team of real estate investment professionals to discover new investment opportunities and accelerate your portfolio. When you sign up at propertyllama.com/taxsmart, you receive a free personalized one-on-one portfolio review with one of their real estate investment experts. Again, visit www.propertyllama.com/taxsmart to get started today. That's it for now. We'll dive right into today's episode. All right, Nathan, welcome back to the show today. For our listeners who may not have heard, your other appearances, would you just be able to give them a quick just overview of how you got here at Hall CPA and kind of what you specialize in?
Hey, Tom. Yeah, thanks for having me on. Yeah, so I'm a senior tax advisor here at Hall CPA. I've been practicing in real estate taxation for the past 6 years or so. It's like a little bit of scattering in other industries too. And so I landed at Hall CPA, and honestly, about a year ago. Been a great time just getting to work with all kinds of investors across the board and just help everybody save on taxes.
Awesome. And I know today we're going to be talking about Section 179, which is an interesting deduction for small business owners and commercial real estate investors. Do you want to kind of just kick us off with what is Section 179?
Yeah, so 179 is basically the forgotten cousin of bonus depreciation, right? So for the longest time, 179 before 2018, right, it was a much more used provision, right? So it's basically 179 basically allows for an immediate expensing of certain capital expenditures, like you mentioned before, right? And it's 100% of an expense, right? When you normally have to capitalize it, is way better than what bonus depreciation used to be, which was 50%, right? So you'd actually get a much bigger deduction way in the past than you do today, right? Well, today, at least we've had the past few years, was 100% bonus depreciation, right? And bonus depreciation has a lot less limitations than 179 does. We'll talk about the 179 limitations today, but basically it's like a no-brainer. It's like, oh, you can take bonus depreciation? Go ahead, take it. It's 100%. But with 80%, 80% was pretty great. So we could kind of just say, well, we don't necessarily need 179. 20% is not that big a difference. But now we're living in the realm of 60%. And it's a provision that we probably need to come back to and explore, at least in the real estate world and other industries as well, I think.
Yeah, absolutely. So kind of long story short, Section 179 allows small business owners and commercial real estate investors to deduct certain capital expenditures in that first year rather than depreciating them. And with bonus depreciation kind of phasing out, it's becoming a little bit more prevalent. I've seen a handful of questions on them come my way that usually were just addressed by bonus depreciation is usually the better answer. But today, as we kind of look into 2024 and 2025, as bonus depreciation begins to phase out, Section 179 will be a little bit more prevalent. So one thing we're going to explore is how does this apply to real estate investors? So first things first, just want to kind of put out there that one of the reasons, and we'll come back to the limitations and the deductions in a moment, but the reason why we haven't discussed this too much is because it's typically not applicable to residential real estate. So that's for all the people out there who are renting their single family houses or condos or what have you on a long-term basis or a midterm basis, as some people, MTRs, often considered, lumped in that long-term rental bucket. It simply does not apply to residential real estate. So if you're in residential real estate, for the most part, you're still going to want to stick to bonus depreciation. However, this is more applicable to those commercial real estate investors, so office, retail, industrial, and as we'll discuss later, short-term rentals, but before everybody goes off the deep end there, we'll color that in with a little bit more information later. So do you want to just dive into kind of what specific types of improvements or renovations rather, or however you want to look at it, would typically apply for this?
Yeah. So according to the code, right, 179 applies to property that's considered quote unquote tangible property. And then 1240, what's also called 1245 property. We've said that a couple times on the podcast. And then the third, like these are the three things, and it has to hit all these items. The third one is it has to be acquired for purchase in an active trader business, right? So that's the only way 179 is ever going to qualify. But yeah, so essentially it's going to be capital expenditures that could qualify for bonus depreciation in some ways, right? There are some things that bonus applies to that 179 doesn't. Now, there are certain qualified improvements that actually are more favorable here than they would be in bonus, and that would be improvements made to roofs, heating, ventilation, air conditioning property, to fire protection and alarm systems and security systems. A lot of times we'd be actually stuck with the bar limitations more times than not, right? Betterment, adaptation, restorations. But in this instance, we'd actually get to expense those items so long as they qualify under that threshold that I just mentioned.
Right. So basically like HVAC systems, roofs, fire protection, security systems, things like that in commercial properties can be expensed through Section 179. And in some cases, those types of improvements, roofs, ring a bell for me, are normally depreciated over 39 years in the case of commercial property. That is powerful. So at this point, could we go through just kind of what the deduction limits are, kind of how that deduction actually works from a more, I guess, numbers standpoint, so the audience maybe understands how this maybe could be powerful for them?
Yeah, absolutely. So you can technically, according to the code, deduct up to $1 million of 179 property. It is inflation indexed. So the current limitation is $1.22 million that you can take as an entire 179 deduction. So you've got a lot of room, honestly, to take the deduction. And then after that, so that's the max deduction you can take in the year. Anything that's above that, right? So this is like the amount of property you place in service. So then there's a second limitation. That is the overall capital purchase limit. And that is at the limit of 3.05. And we're like, why does that matter, right? So what if you put in $3.05 million of property? If you actually put in $3.3 million of property, then you begin to get phased out of your deduction, right? So whatever the amount of property that goes over that, it now gets reduced by the amount you've gone over that 3.05 million, right? So if you like I said, if you put $3.3 million in, you have to reduce your deduction by $250,000, right? So that's just something to keep in mind, right? Like, be honest, I have not seen it happen all that often, only in very like equipment intensive type business, manufacturing equipment types of businesses. So not saying it won't apply to real estate, right? It won't apply to commercial and those types of items, right? But it's just something to think about if you've got a lot of capital expenditures that you're trying to deduct and take immediate expensing on.
Right. So it is powerful, and it seems like it really, the only time people really come into any serious limitations on this would be if they have like substantial size properties. I would have to imagine at this point. And so, yeah, that makes a lot of sense. So for commercial investors, this could be something you want to take a look at. Again, if you do have HVAC systems, roofs, fire protection systems, it could help you. Hey, are you tired of working with generalist CPAs that tell you can't use the real estate professional status, the short-term rental loophole, or cost segregation studies, or worse, have no idea what these things are? If so, it's time to elevate your game and work with a CPA firm that gets it. Here at Hall CPA, we worked with thousands of investors, helping them save millions of dollars in taxes through proactive tax strategy and planning, tax preparation, and outsourced accounting solutions. So if you're ready to elevate your game, make tax filing painless, and save thousands of dollars in taxes, what are you waiting for? Just head on over to www.therealestatecpa.com/podcast to request an initial consultation today. We are accepting clients for the 2024 tax year, so if you're looking to make a change, you have nothing to lose. Again, you can request an initial consultation by visiting www.therealestatecpa.com/podcast. We look forward to hearing from you and learning more about your situation and how we can help. But for now, we'll dive right back into today's episode. Now, again, we haven't seen this too often or questioned too much because of it only applying to commercial investors and bonus depreciation being the more preferential option for many investors. But kind of drilling down into this, I know me and you went back and forth on this for a while, and we kind of figured out a strategy for this and how this can help you actually reduce perhaps W-2 income under certain circumstances. So maybe we could break this down just a little bit. Section 179, the actual deduction, is limited to the business income of the taxpayer, but there's some caveats in here. So just correct me if I'm wrong on this next statement. I'll let you take the next part of it here. But if you have a partnership, or if say you own a commercial property in a partnership, which is very common, right? Very common for commercial real estate. Not always, but common. Then your Section 179 deduction would be limited to the business income from that specific entity, say partnership A, for example, and wouldn't necessarily if you had like basically a deduction in excess of the income from that property, that would be trapped, if you will, in that partnership and wouldn't make that deduction the excess deduction. So the amount over the income would not make it onto your personal tax return.
100% right, Tom. That's exactly it, right? And that's why that's what made us think about the strategy we're about to talk about. But it's like, yeah, so if you've got any kind of pass-through entity and your 179 is going to be limited at the entity level. So like if you have $1 million of income, right, and we take $1 million of 179, great, no problem. But if you have $1.1 million of 179, only $1 million of income, you're going to get limited there, right? So that extra $100,000, it doesn't disappear, thankfully, right? There are certain circumstances where you do lose deductions, but not in this case. Basically, just it carries over into the next year, so it's still eligible for use. You just don't get to use it that year, right? And like the whole goal of immediate expensing is time value of money. We want to reduce our taxable income now, so we can get bigger tax refunds and use that money to invest, do whatever we need to, maybe go even on vacation of something of that nature, right? So that's the whole point for that. But it's like me and you were doing a little bit of extra research, and this is something that we stumbled across, is that taxable income limitation for the taxpayer. So if you own anything commercial, anything that ends up being 39-year property at the end of the day, the taxable income limitation applies to other investments as well. So if you have other pass-through investments that's producing income, if you have other things with those types of item, then 179 will flow out and offset those other types of income. Specifically, the most interesting piece is this, like, all those businesses have to be considered an active trade or business. And oddly enough, in the tax code here, this is one of the few places where having the active trade or business of being an employee is actually really important, because that means, since that got pulled in to the 179 regs, that you can use 179 deductions to offset W-2 income, actually, which is insanely powerful, especially if we're going to talk about short-term rentals here in a bit.
Yeah, just because I know this is going to be a point, and I don't want people to run off and run away with it
yes.
and misinterpret this. So first, just kind of like set the stage here. In order to use these, say, Section 179 losses against W-2 income, you'd have to be a real estate professional, or you have to be perhaps materially participating in a short-term rental. If it's passive, it's still passive. It's not going to be able to offset your W-2. Is that correct?
Yes, 100%. Yeah, I forgot I should have mentioned that. Yeah, you have to materially participate, be real estate, etc.
All right, cool. So that's kind of the first thing. If you're a passive investor, this might not apply to you, okay? But you have to be actively involved. Again, either a real estate professional in the case of commercial real estate, or perhaps short-term rental, a loophole in the case of short-term rentals. But just to kind of clarify here, so let's just say I own a short-term rental, which is generally considered a commercial property, and we'll get into that in a second. But if it's generally considered commercial property, I own it in my personal name. It gets reported on Schedule E because I'm not providing substantial services. I'm materially participating. It's non-passive. And I take a Section 179 deduction. Let's just call it on the HVAC system, right? And let's say this deduction exceeds the income from that specific property. Then I could use it to offset my W-2 income.
100%. Yeah. The key with the HVAC system, though, is that it needs to be qualified improvement property, or we say QIP a lot of times, and so it needs to be done after the property is placed in service. But if that's the case, 100%, the entire cost of that HVAC system, you'll be able to expense and fully, immediately expense right off against your high W-2 income, as long as you materially participate, like we talked about with the short-term rental loophole.
Okay. But if it's in a partnership, say it's not in my personal name, say me and you went ahead and had a short-term rental, I materially participated in it. Maybe you didn't, or maybe we both did. Doesn't make a difference. But in that case, what happens in that case? Does the same thing still apply? Does that Section 179 deduction flow through and still be able to offset the W-2 income, or is it trapped still in that partnership?
It could flow out, but it depends on the income from the partnership, right? If we've got a sweet short-term rental and it's crushing it, and we've got tons of income, and we use all the 179, right? So it will flow to our 1040, but we might not. It might get applied first to the short-term rental income and not our W-2 income, right? So we might not actually get to fully benefit from it. So essentially, like, we're just offsetting rental income. We're not going to necessarily now, and so vice versa. Like I just mentioned, if our short-term rental is not doing that great, it's not in a great market, and it's not cash flowing well, so we still use 179, take the entire deduction. It's not going to pass out to our 1040, unfortunately.
Okay. If everybody listening, I know this is potentially exciting, right? A new way to potentially offset W-2 income. But just to be clear, this strategy works if you have a commercial property, which could include short-term rentals, that you own either through a single member LLC that's disregarded for tax purposes, or in your personal name where it would get reported, where that property gets reported on your Schedule E as the same taxpayer, right? If you have it in a partnership, your deduction is going to be limited to the income in the partnership. It will show up on your 1040, right? But it's unfortunately not going to be able to, if you have it in a partnership, the deduction will not help you offset the W-2.
We don't leave any ambiguity out there, and like a lot of people start running off and trying to use 179 all over the board. That's the limitations with 179. It's a great tool for real estate investors, but bonus depreciation has far less limitations, allows you to create these losses to use them against other types of income. 179, when it comes to it looks at almost like from a entity or taxpayer perspective, and so there's limitations that exist there. So that's why it's, even though it's great and it can be really great for reducing income to zero, it's not great for creating losses. And so if you had it in a partnership, it's not really going to be helpful for you to offset W-2 income.
Yeah, absolutely. And now we're talking about this a little bit deeper here. This is just another reason why you haven't heard so much about this, because again, usually commercial properties are held in partnerships, right? Really where this comes down to, I think the major use case for the people probably tuning into the show would be for your short-term rental. Why your short-term rental? Because your short-term rental is considered commercial property. And we'll get into the code sections here in a second on that. But is considered commercial property, and you could own that, or it's not uncommon to see people own that in a single member LLC or perhaps in their personal name and not in a partnership.
Correct. 100%, Tom. And one other thing to caveat too for 179, for certain states that don't conform to bonus, 179 can be useful because some states do conform to 179. And so that would allow an immediate expensing, while you could have gotten 100% or 80% bonus depreciation, but you were limited actually, right? So like where 915 is coming up pretty quick, but it's like, for some people, it could actually help you, like depending on like your state level of tax rate, like your state and the amount of income you're taxed in your state, could be advantageous potentially to look at it from that perspective. But almost more times than not, I've always found that bonus depreciation is still more useful.
Absolutely. And that's been my experience too over the last number of years, which is why I don't remember a time where outside of maybe a small business, where I personally advise somebody to use Section 179. But again, things do look like things are kind of turning the curve here on it. So before we dive into this last section we have here regarding why short-term rentals are considered commercial property, just want to give everybody the caveat. Again, this is not new, but this is the first time we've introduced this here on the show. So if you do have questions about this, I would not go running off and running away with this. I would recommend that you talk to your tax advisor about this. I know we have a great team over here, including Nathan. So go ahead, if you're working with us, if you're a client of Hall CPA, go ahead and ask your tax advisor if you think this is relevant to your situation before just going and implementing it. I would not recommend just running off with this. If you're not a client of ours, we do have the TaxSmart Insiders Forum. We do have that live Q&A system, one-on-one consultations. You could also learn if this is appropriate to you through those channels. And you can learn more about that by going to www.taxsmartinvestors.com/join-insiders. And you can become an insider today if you do have questions and you're not a client of Hall CPA. Or you could go ask your tax advisor, your current CPA. But I just don't want everybody to run off. I've seen this happen. We've seen this happen with the short-term rental loophole. We did the episode on the short-term rental loophole a few years ago, and people ran away with it. And that's why we had to get so extensive with those series to really break down all the details. I'm just concerned that people are going to hear this and be like, oh, yes. So,
I mean, yeah, Tom, I was like scrolling on TikTok the other day, and there's just like so many people who talk about 179. It's more specifically to vehicles, right? It's like there's like, oh, you can totally write after your vehicle 100%, right? As long as it's over 6,000 pounds and there's no, like, it doesn't hit the sports utility limitation, which is $35,000, right? So it's something that's funny to see. It's like I forget who it was exactly, but someone was saying, so like, oh, here is my basically my Jeep that I've overhauled to be a war vehicle now. And it's like, there's a machine gun turret on top and I deducted all of it, right? It's like a totally different conversation of like why that doesn't work. But yeah, people are like, there are some people out there who are like, hey, use 179, just like the short-term rental loophole. There's like totally abuse this. Guys, don't do that kind of stuff, right? The TikTok advice is not great. Like Tom's saying, consult your tax advisor, talk with them through all this, right? There's that nice little 162 ordinary and necessary business deductions that comes into play for those types of things. I'm not sure. Last I checked, we're not at war, so I don't think we really need that. I don't think you need a war vehicle to go do that. I can't remember who it was, but yeah, it's like just something to think about there, and don't get too aggressive with this, please. Like definitely stay. Like a favorite line of mine from another CPA is, pigs get fed, hogs get slaughtered. The more aggressive you get, the more likely an audit shows up to your door and you can't substantiate a thing. But if you play with the bounds, then you have a more likely than not chance of being able to continue writing things off.
Right, 100%. And as Matt Rappaport said, and we had Matt Rappaport on recently, we'll have to have him back again soon. He told me a few years ago, he goes, you don't want to get too cute, right? You don't want to get too cute, which is very much in line with what you're saying. Pigs get fed, hogs get slaughtered. And you just want to make sure that when you're using advanced strategies like this, that you're just doing it the right way. And sometimes that involves seeking the advice of a qualified tax professional. And I know that might sound a little self-serving for us, but it's really not. I've seen so many errors, and we've been getting STR tax audits, left and right, people coming to us from outside of our firm, getting into trouble because they went it alone. So it's not, we're here to just try to make you aware of these things so that you can go have more intelligent conversations and more thorough conversations with your CPA on how this is applied. One of the last things we have here before we wrap this up, summarize it, put a nice bow on it, is going to be, why do short-term rentals qualify as commercial property? Because it's kind of foreign to some people. I know we've covered this here on the show before, but you buy a single family house, or you buy a condo, or you buy a townhome, or whatever the case is, and you're like, oh, this is a residential property. It's in a residential neighborhood. Shouldn't it be a residential property and not non-residential property? But if you look into the tax code, specifically IRC section 178E2 cap AI, it says that dwelling units that are used as a hotel, motel, or other establishment or similar establishment, those are typically going to be considered non-residential property, or in this case, what we would refer to more in the real estate industry as commercial property. Then this falls into that bucket. And again, if a short-term rental is a commercial property, then you could apply section 179 to certain deductions, as we discussed here today, that you would maybe not be able to apply on a residential property. Anything you want to add there, Nate?
No, that's fantastic, Tom. Yeah, it's like basically that, like, again, in the same line of why we think the short-term rental loophole works is in a similar way it works here for 179 deduction, right? So as long as you have, like you're mentioning, at the transient stay, then we will be able to use 179 on short-term rentals, right? And again, is that like this is not necessarily court tested, but it doesn't necessarily mean that it's not possible either, right? It doesn't mean that we can't take advantage of this deduction for short-term rental investors who are doing cost segregation study, who are putting new improvements in, right? Having to replace the HVAC, right? Normally, we have to capitalize those items, appreciate over 39 years. Not as effective from a time value money perspective. But here with the immediate expensing could definitely be super useful here.
Yeah, and I think when it comes to tax court cases and audits, this might trail, just like short-term rentals have trailed the audit space, because what ends up happening is we were using bonus depreciation. That's been the most prevalent thing for short-term rentals, and now you're starting to see some of that come to light in audits. But what I mean more specifically within audits is people who've applied the rules wrong, right? They're getting audited and potentially sometimes even losing audits. But if you apply the rules correctly, then audits become much more defensible, right? So you want to make sure you're applying this correctly. But it might take a few years for this to cycle out through the tax system, if you will, to see that come to light. Because if you start taking 179 2024, it might be 2025, 2026, 27, whatever, before you see an audit on this. So is there anything else that we have not covered on this strategy or on section 179 that we should be covering?
Yeah, and Tom, what like another thing to bring up in regards to that is that 129 still has the same recapture rules that normal depreciation does, right? So in that same vein, it looks different on your tax return. However, at the end of the day, it's still like it's like if you use 179 and like you take an ordinary deduction today, that means when you sell a property, you'll have ordinary income tomorrow. So it means whatever piece of your gain is associated with the 179 deduction, you will be recaptured on that at ordinary income rates. So there's no way to get around that. And same thing is like if you do take it on the vehicles, right? If you take a full 179 deduction on the vehicle and it's over, you fall below that total business use, that total 51% business use, then you will have that excess recapture that occurs at that point in time. So just to recap, 179 recapture looks different on the return, but from a tax rate perspective, it performs the exact same way.
All right. So that's important to note. There's no free lunch. But if you've been using bonus depreciation or you're considering using bonus depreciation, it really isn't that much of really too much of a difference from the recapture standpoint. So
one other thing that you can do that like it might not ever apply is that you can combo 179 with bonus depreciation. So even though like we mentioned, there's a $1.22 million cap on 179 currently. Now, if you have any deductions, like if you have qualified property over that limit, you can use bonus depreciation on anything that would be above that, right? So if you have a piece of property, let's just say you've got $1 million, let's say you've got $1 million of 1245 property from a cost segregation study. And so it's over. So you totally take $1.2 million, write it all off, but you still have maybe $800,000 left, right? To that is eligible for depreciable basis. That means you could use 60% bonus depreciation, since that's what we're living in right now for 2024, unless Congress comes in and changes something, which fingers crossed. But you'd be able to use 60% on that additional $800,000 in this example of like a $2 million $2 million of eligible 179 / bonus depreciable property, right? So you can combo this. It is possible, right? It's just, again, it's everyone thinks it might apply to the exception applies to them. And more oftentimes than not, you are not the exception to the rule. You are the rule. So it is definitely a possibility, but it's more likely than not that you can't do it. One funny tidbit I did find when I was doing my research is that rare birds are also eligible for 179. So if you have rare birds at your short-term rental, you can take 179 deduction on them. I don't know. That's definitely not going to apply to like even like a percent of our listeners. But hey, if you've got some rare birds, you got a zoo short-term rental, let me know. I'd love to come stay. But it's a potential opportunity for you.
You'd actually have to own the birds at this point. They can't just
correct. Yeah. And actually, it has to be for like it has to be for breeding purposes too. So it's like, yeah, I don't even know who this applies to, but it like apparently came up at one point in time. Someone asked like, "Hey, is this possible to IRS?" And they're like, yeah, I guess so. we'll let it slide.
It's those crazy things. Like I think there's a crazy law in some books somewhere that like it's illegal to cross the street while having an ice cream cone in your hand or something crazy like that. So these little nuances you never expected to be there are somewhere in there. But I just kind of wanted to summarize this real quick for everybody. Okay, so long story short, Section 179 is a deduction that allows commercial real estate investors and small business owners to deduct certain capital expenses immediately rather than depreciating them. Short-term rentals, because they're on a transient basis, do qualify as commercial real estate. Again, 7 days or less, 30 days or less with substantial services. Now here, that kind of puts you into this window. Now, if you have a partnership with commercial property, which tends to be the case with larger commercial buildings, like say industrial, bigger strip mall or an office building or self-storage or something like that, those are typically going to be in a partnership. Not always, but typically in a partnership. If you use Section 179, you're able to offset the income from that partnership or the income from the property within the partnership, but it will not be able to offset your W-2 income because that loss is, quote unquote, trapped within that partnership.
Mm-hmm.
So that's something to keep in mind. Still might be beneficial to use Section 179 in those cases, but where the real power of this comes in is the W-2, right? If you have the property, which often applies to short-term rentals, in your personal name or single member LLC.
100%. I totally agree, Tom. Yeah, it's like if you got a hotel that's really income producing and you own that in a partnership with someone, could be a great way just to get your income to zero, which is never going to be helpful to offset other types of income. While like what you were just saying is that like if it's on your 1040, you own it by yourself, disregarded entity, something of that nature, and you utilize this, it actually can help you save 179 just like bonus depreciation could, as so long as you materially anticipate and hit all those things that we've talked about before. But yeah, definitely a strategy that people should be looking at more if one, we don't get any legislative change from Congress coming up this November, or two, in the current year and at 60% bonus depreciation. Definitely something to take a look at. And even if it keeps falling and depreciation sunsets, 179 will become even more prevalent as time goes on.
Right. Absolutely. And so the last thing before we wrap up, we will be hosting, and I know Nathan's joining us on September 18th. We're doing taxes in bourbon. We're going to be going live at 7 p.m. Eastern on YouTube, Facebook, within our Tax Smart Investors community, the public community we just opened. So if you're not already in the Tax Smart Insiders community, but you want to get more access, you want to find out when events are going on, you can join the free public community by going to www.taxsmartinvestors.com/public. Join today, you'll be able to get information on when our live events are coming up. But we're going to be going live to discuss the presidential tax plans. We already did a podcast, but since there's been some more information that's come to light that we'll be discussing on that September 18th live, taxes in bourbon. Bring your bourbon. We'll see you there. Also, if you are interested in the Section 179 strategy and you're not sure if it applies to you, or if you're not sure how specifically to use it, but this episode today kind of piqued your interest in it, do go speak to a tax advisor. If you don't have a tax advisor, we are accepting clients, but we are kind of moving into the year end. So now's the time to start to act. You don't want to wait and drag your feet. You can request a free 30-minute discovery call by going to www.therealestatecpa.com/podcast or by clicking the link in the show notes. And you can go ahead, speak to our team, see if there's some way that we can help you out. We'd love to learn more about your situation and discover that with you. So with that being said, Nathan, I want to thank you again for joining the show today. And we will be seeing you on the next episode of the Tax Smart REI podcast.